What we're going to move on to now are looking at, and remember, this is a topic for the CTA students only, we're going to look at the taxation of trusts. Now, trusts has often come up in a UNISA type test situation as a full-blown question on its own. So please make sure that from the introduction we're giving today, you go and do a careful analysis of your TUT letter and focus where UNISA requires focus, and make sure you've got an understanding of this overall working of a trust. So let's start from the beginning. When we're looking at a trust situation, what's going to be the issue is we have to examine various taxpayers in respect of a trust and how the different sections that we're going to look at move a tax burden away from the trust to another taxpayer. So let's have a look at the main people involved. Firstly, we have somebody who is the creator of the trust. Then we have the trust itself, and then we have the people who are going to benefit from that trust, and those are a beneficiary of the trust, or known as a group, the beneficiaries of the trust. Now, a trust is created through a trust deed. So the trust deed is the legal document that we utilize to create this thing called a trust. Now, importantly, a trust is regarded as a person for tax purposes. So what do we mean by that? The trust itself will be regarded as a taxpayer. So just like whoever creates the trust is a taxpayer, beneficiaries of the trust are taxpayers, and then we have the trust itself, who is a taxpayer. What we are going to examine now is how the tax consequences of various trust assets and income amounts flowing into the trust, the tax consequences of those trust assets or amounts coming into a trust can sometimes be borne not by the trust itself, but sometimes by one or other taxpayers outside of that trust. And that's what we're going to focus on today. How does that all work? So once we know a trust is created by a trust deed, we will find that essentially there are two types of trusts. One is known as an inter vivos trust, and the other as a testamentary trust. An inter vivos trust is a trust deed that is drawn up, and the trust itself is created while the creator is still alive. So I could, for example, go to some attorneys and say, I want to set up a trust. We draft a trust deed. That trust is registered with the High Court, and I'm still alive, the creator of the trust, and therefore it's an inter vivos trust. What is the opposite of that? The opposite of that is a testamentary trust. Now, what will happen is, in a last will and testament, a person who is dying, on their death, in their last will and testament, they create the trust, and that trust is then created after the death of the person in terms of whose will and testament that trust came about. So an inter vivos trust created while the creator is still alive. A testamentary trust will come about because of the death of somebody and their last will and testament giving rise to the trust. Now, it's very important that we examine first off, when we're looking at any question, what type of trust are we looking at? Are we looking at an inter vivos trust or a testamentary trust? And this is because what's going to have to be examined is how did the assets that are held by the trust get into the trust? We really have to examine how those assets that are in the trust got into the trust. So how can they get in there? If the trust is an inter vivos trust, meaning created while the creator was still alive, then there are a number of ways that assets can get into the trust. So if, for example, we have a taxpayer and he wants to get assets out of his name and into the trust, how can he do it? Well, he can sell them to the trust and he can donate them to the trust. So those are some ways that while the creator of the trust is still alive, they want to get assets into the trust. How can they do it? They can sell them or donate them. Now remember, we must take into account all of the parties to this transaction. So if assets are sold into the trust and those assets are sold in at market value, that means that there will be CGT in the hands of the seller. The proceeds will be whatever the trust has to pay that seller for the assets. The seller will then subtract from those proceeds the base cost and calculate CGT.